And with that, I am going to not waste another moment, but turn it over to our experts at Graystone. We've worked with Graystone for over 30 years, 32 years. I said to Brian, I don't know how he looks so young, but 32 years of relationship, and he started when he was 10. So it's pretty amazing. And his team has been such great resources to the foundation, and I know to many of you. And with that, I will turn it over to Brian Sharpes for the presentation.
Nice to see a bunch of familiar faces. Again, thanks for joining this year's version. It's going to be an interesting conversation, right? There's lots going on. This is one of the more unique moments in time, especially when we think about what's going on in technology and AI. And so we're going to cover a little bit of that. Dan's going to share the agenda here. We'll kind of go through the conversation. The intent is to go through this reasonably quick and really open it up for questions at the end, but we're going to make sure to share as much information as we can. So the introductions, again, for those that don't know, my name is Brian Sharpes, Managing Director of Graystone San Francisco. Our team specializes in foundations and endowments. All we do, we manage about $15 billion. It's a combination of colleges and universities, obviously community foundations, large philanthropic families, basically family offices that are dedicated to philanthropy, some environmental organizations, impact organization. It kind of runs the gamut. 30 years of doing this. Again, it's been a while. Dan and I live and breathe this every day, and we know the challenges that you guys have out there is this, it's never easy. The market's constantly changing. Donor interest is constantly evolving. And so the intent here today is to talk a little bit about what we're doing, how we're working with the community foundation, and hopefully provide a little bit of information that you guys can go back to your boards with as well. So we're going to start off. Dan's going to talk a little bit about the process and how we work with the community foundation and what that looks like, and then I'll come back.
Yeah, great. Hi, everybody. Nice to see you all, and really excited to be back here chatting with you all about how we work with the Community Foundation. And this is just kind of an overview of how we engage with the investment committee and the staff. And Brian mentioned 30 plus years of working with the foundation. That's gone through multiple CEOs, multiple investment chairs, changes in the board. We've done several competitive RFP processes where they've gone out to bid and looked at other options. But also through that 30-year history, we've been able to build a really deep understanding of the organization and the community. And I think that adds value to our investment process. And so that's kind of that first one is really understanding who the foundation is as an organization and who the underlying constituents are, all of you, right, that are the source of funds for the foundation and the connection to the community. Through understanding that and understanding the objective from an investment perspective, we develop an investment policy statement that is kind of our true north and guiding blueprint for how we manage the portfolio. And there are multiple portfolios. We're going to talk about that in a moment, but this really, identifies what's the liquidity needs of the portfolio, what's the risk tolerance of the portfolio, what is the actual, return objective of the portfolio, and what are the building blocks of asset allocation that we need in order to achieve that outcome. And the board establishes guardrails for how much risk we can take within each pool and what we're trying to accomplish. And so that's all documented in the investment policy statement. It's reviewed every year by the Finance and Investment Committee, and brought to the board for full approval anytime there are changes that are needed. Once we have that blueprint set up, we start looking across the investment universe at all the different asset classes, and so this means U.S. stocks, big, medium, small size companies, international stocks, emerging market stocks, bonds, private equity, private credit, real estate, kind of the whole gamut of available investment opportunities for an institution of this size. And we run through some very in-depth modeling to identify what's the right mix of these asset classes that achieves the long-term return objectives of each pool with the least amount of risk and the least amount of volatility, right? And then through that building block process, we identify the combination of asset classes for each pool, and then we start filling in those buckets in terms of underlying investment managers. And so some of that is very, very low cost ETFs to just get exposure to an asset class in certain areas that we think are less efficient, and we identify managers with unique skill that we think can outperform the market either through better upside participation or more downside protection. We will pay up for active management in certain places. And then we're doing an ongoing evaluation of those managers. How are they performing relative to their benchmarks? Why are they outperforming or underperforming? And working with the committee on adjustments and changes to that over time. I just want to make sure, can everyone still see my screen? Because my screen just changed and now I'm seeing the gallery. Okay, great. So from once we have the manager lineup put in place, we're also working with clients kind of across our practice and across our firm to ongoing negotiations of fees to make sure that we're getting the most for our money, and any fee savings that we're able to get through those negotiations passes straight on to the foundation in the form of lower costs. And then we're reporting on a quarterly basis to the investment committee. We're actually sending monthly reports, but the formal review process happens at least on a quarterly basis. And in the event that any...
I think you need to reshare your slides. Sorry, we're not seeing that anymore.
Thank you for letting me know. Okay. And then, an ongoing review, right? Things change within the organization, things change within the financial markets. And so we need to, bring that back to the start of the process of understanding where we are and where we're going, and make sure that that's documented properly in the investment policy statement. And just for those that are less familiar with this process, why is an investment policy statement so important? And it's really about governance, right? Documenting the process, documenting the investment philosophy, the objectives, the risk tolerance, and it's designed to encourage good financial decisions in the worst times, right? And if we think back over the decades that we've been working with the foundation, we've been through multiple market cycles, multiple financial crises, and the decisions that are made in those toughest moments are really make or break an organization. And by having a disciplined investment policy statement that governs this, that really allows the committee and us as the investment consultants to make good decisions in those times of stress. It also is an opportunity for us to express the values of the organization and mission of the organization, and allow for specific alignment with certain pools of the mission of the organization or with donor intent. And we're going to talk a little bit more about that as we get into the underlying pools. And then the other thing is, yes, it's designed to help the organization navigate multiple market cycles, but the reality is a lot of things have changed over 20, 30 years in the financial markets, and we need to update it to make sure that it's relevant for both the organization as it is today, as well as the financial markets. And then from an investment strategy perspective, there's a lot on this slide, but I'm just going to keep it really simple. I already mentioned that we use low-cost ETFs. We think of our strategy as what we'll refer to as core satellite, the core being indexed, low cost, just getting exposure to asset classes, and then the satellite strategies being active managers or tactical positions that are outside of that core. And that's, alternatives is a big component of that. We'll talk a little bit more about that as we get into the portfolio. So with that, I will pass it over to Brian to talk through the different investment pools.
So at the end of the day, this is about the choices that you guys have in terms of how you partner and invest with the community foundation. one of the really nice things is that this foundation has been on the forefront of being innovative in terms of new pools. We see every day very significantly, well-known community foundations that are actually in the billions and billions of dollars that have like one option. The reality is, the investment committee and the staff has been committed to making sure that we have a variety of choices that meet the needs of each organization. And so this is just a short list. It talks a little bit about the investment objectives, the asset allocation, the expenses that are involved with each of the pools. And I'll go in a little bit more detail, but we've got the long-term pool. That's the traditional pool where we're trying to maximize returns over the long run, about a 7% return target. You'll see in the performance, it's actually done quite a bit better than that, but that is ultimately the goal. We need to hit that number. Again, you can see the asset allocation and the expenses there at about 51 basis, 0.510%. So it gives you a feel for that. Socially responsible, this was a portfolio that was started in 2004. Quite a bit of controversy, believe it or not, in 2004 when we started this portfolio. You can see it's $76 million today. So, it's been one of the faster growing pools that we've had. And again, 7% return targets, no different than the long term. The idea is that we're, again, environmental, social governance, impact investing principles. We'll talk a little bit more about that. That's really the core of what's going on there. That portfolio, interestingly enough, in the last 5 years or so has actually done better than the long-term portfolios. There's been more emphasis in this space. So that's kind of an interesting note. Women's inclusion. This is a portfolio that was really started with one particular donor that, and when this started, by the way, there weren't a lot of these portfolios around where we really wanted to make sure we were investing where we're trying to promote C-suite, board members, female representation. This portfolio has come a long way. There were very few options when we started, and today there are a lot more. And the entire investment landscape has changed to a point where they're doing a much better job. We have a long way to go, but we're doing a much better job in this space. And so we feel like we've been part of that, again, as we've committed dollars to this. That portfolio started, and I'm going to say it was a little bit less than $1 million, and really impressive that it's already in early stages up to around 8. And then short duration fixed income, this is where we're trying to get a little bit more return than cash without a lot of volatility. That portfolio has been around a long time. And then capital preservation, it's simply money market. Don't take any risk. Make sure that we get the best return possible, but we cannot lose capital. If we think about some of the things that we've been working on over the last 30 years, one of the things is really mission alignment. Investments, it's easy to invest in index funds, and we certainly do a lot of that, but we also are trying to be aligned and really start thinking about, ultimately who in the community is using and how can we use the investments to actually better the community. And so again, we mentioned social responsible started in 2004. Opportunity Fund was a very early investment in 2015. Rethink Impact, interesting enough, that's a female-led, and they're looking for female-owned VC businesses. It's one of the better PE managers we've had. They've had phenomenal performance, and that was very, very early on, back to 2016. Women's inclusion in 2018. You can see 2020, we had starting to do a lot more of the impact loans in the community, right? And that has had a significant impact as well. Let's go one more page. Yeah. Gender Lens in 2020. JCM Grosvenor, which was actually trying to promote minority investment managers. And that fund has done reasonably well. And then again, as we look into 22 and 23, some clean energy, TPG on the impact side, again, trying to really broaden out what we're doing. And then more recently, we've been very, very active. Dan, go one more. This is just the most recent couple years here. Again, you can see the list of what's going on here, but Apex and Heritage is, I'll call that out specifically. It's actually giving capital so that employees, minority employees, can buy out businesses. That they might be 10 employees that have worked for a business for a long time. It's been owned by a family for many, many years. They're getting older. Basically, they provide the capital to do an ESOP to allow these employees to buy and actually have equity in the business. Really interesting strategy. It's been quite popular. They're raising a ton of money, and again, really, significant dollars into the minority community, trying to figure out how do we gain equity, right? Because that's where a lot of the wealth is created in today's world. And so again, just giving an idea of kind of some of the things that we've been working on and thinking about. Really, this again goes back for many, many decades. And then we just wanted to highlight a couple things. Social responsible portfolio. What are we trying to do here, right? So it's partly an exclusionary approach. We're taking out some of the bad actors, but then we're also trying to integrate companies that are doing things well by the environment, socially, on a governance basis, really emphasizing those companies. And then impact investments, those are direct investments where we're trying to have an immediate impact on a community. And these can be concessionary returns. They don't necessarily need to be. We've had a combination of those things going on in this portfolio. And again, a long history, and we'll show the results here in a little bit, really has done well. The next one is, again, as I mentioned, the women's inclusion, 2018. Gender diversity is the screen, right? Gender diversity leaders, and then gender lens investing. This is a much narrower, more specific, and really at the end of the day, we wanted to have an impact. We wanted to put capital to work in this space and tell the investment community, we're watching, we want to see what happens, and we want to see progress. And actually, since 2018, we've seen quite a bit. Again, not that this isn't done, but you see many more women in the C-suite. You see many more owners, partners. You see, a whole generation of young professionals coming up much faster than they had done in the past. So again, trying to make a difference here, not just in this community, really just more nationally, to be honest. And then I think that was the last one. So Dan's going to talk a little bit about some of the diversity stats that we've been actually tracking as well. And this data has been pretty interesting.
Yeah, and this really started in earnest in 2022. Initially was focused more on the women's inclusion portfolio, but then we extended that to the social responsible portfolio and the long-term portfolio over time. And it's less about the absolute numbers, and it's more about seeing the trend over time, and the fact that we're requiring the managers that we're working with to report these numbers so that we get transparency into how they're operating their firms and the types of businesses that they're buying. And you can see in the social responsible and women's inclusion portfolio, every manager firm that we work with has a firm DEI policy and is considering DEI in their security selection. And so that's good news. And to Brian's point, we are seeing an impact within the industry.
And we're going to take a little bit of a turn. We did want to give a little bit of market commentary before we kind of dive into the next stage of the actual portfolios. And again, it's just because of what's going on right now, and there's a lot of headlines. We wanted to hit 4 or 5 slides here and just give a little perspective. So number one, returns this year have been actually quite good. It's really because underlying company earnings have actually been good. It doesn't necessarily feel that way out there. But if you look on the lower left-hand side here, you can see earnings estimates. They've been going up. And that's partly why the stock market has done so well. The one thing that we're the most concerned about, though, is this is on the right-hand side here. You can see the S&P 500 current and historical valuations. And the way we look at this, and I'll just highlight the forward price to earnings. So the price of the stock divided by its underlying earnings. We're trading about 20 times earnings. To put that in perspective, the tech bubble was 26, financial crisis was 11, the 20-year average is 16, and you can see we're trading at about a 23% premium to where we've historically been. And you can kind of go down the list and see here, it feels like in most places we're actually slightly overvalued compared to history. Interest of, look at technology.
What's that?
Yeah, technology
take them all, yeah.
And so, most people would think technology is really expensive, and the hyperscalers and some of those are, and there's certainly AI things that are crazy expensive and some of the chip manufacturers. But in aggregate, actually, technology is not as crazy. Look at the tech bubble. It was at 62 times earnings. We're at 22 today. And then again, as you go down the list, you can see just the market's priced basically based on that things are going to really be okay. And we've got a lot of things going on right now that are contrary to that. There's two things that we're most concerned about. Number one is we have the midterm elections. There's all kinds of weirdness that happens during the midterms. There's all kinds of predictions. Nobody really knows what's going to happen until it does. And the market, as the closer we get to November, will start trading on a lot of that, and then ultimately will react to the results. Divided government in terms of a Wall Street perspective is always good because it's harder to get things passed. As one party gets control, the market will like that less, whether it's Republican or Democrat. So again, just some headwinds on that. And then on a geopolitical standpoint, obviously oil, and there's so much of the economy is based on oil, and certainly what's going on in Iran. The current futures in oil says prices are going to go down. I think that's making an assumption that this gets resolved. If it doesn't get resolved and we continue this issue, at some point you're going to get a spike in oil prices. You could get a spike in inflation, and that's going to be very troubling to the markets overall. Go one more page, Dan. Just wanted to give a little perspective of returns for the year. The S&P 500 is up about 10% for the year. Small cap stocks you can see are up around 19. International stocks really now for the last 3 years have done better than US stocks. And you can see the world market's up 11.6, emerging markets up 20. And then we go to bonds, and that's on the right-hand side. You can see the blue. Whether it's US treasuries, tips, corporate bonds, bonds have really struggled. And bonds have struggled because interest rates are going up. So it's something that, when you think of a community foundation or you think of your investments with the community foundation, we're going to have a portion of the portfolio that's conservatively invested, and that happens to be in bonds. So when bonds yields go up, the price of the bonds goes down, and that's what we're seeing. Overall, we're expecting about a 4 to 5% return from bonds going forward. That's actually very healthy for the portfolio. And then the last thing I want to point to, a diversified portfolio. So if you have stocks, bonds, and alternatives, just a fully diversified portfolio is up about 4.4% this year. So you can see again, that's pretty good for the first half of the year. Again, our expectation is it's going to potentially get a little bit rougher going forward. I'm going to hit one last slide, and then we'll continue to move on. But I did want to just show that this is some stats on technology. And you can see momentum on the top left-hand side, momentum names, a lot of the big techs. You can see there they've already started to sell off a little bit. Whether this is software companies, they certainly have struggled. Even some of the big, on the right-hand side there, you can see the hyperscalers, the big tech companies have also struggled relative to the S&P 500. And I had somebody describe this very well to me, and I thought it was a good analogy. These 7 or 8 big tech companies were really dominant in their particular area for the last 10 years. What's happened is they're all now fighting in one way or another in this AI race. And there's going to be some big winners and the big losers, but the reality is they're all sort of fighting for the same thing. It's not realistic to expect the returns from the last 10 years to be similar in the next 10 years. It's going to be harder for them to do that. And so more diversification, more broad ownership of securities, in our view, is really key to good portfolio management going forward. So again, I don't want to sound doom and gloom. I'm not necessarily doom and gloom, but I think the second half of the year is going to be a little bit tougher. And we'll see how this all sort of plays. I'm actually going to go one more slide. Dan, go to the debt side on the AI.
Mm-hmm.
I do want to hit one other thing. There's a lot of conversations about AI and AI spending. It is unbelievable how much is being spent in that space. And the revenue is very questionable whether it's going to come through. But I just want to point out to one of the things, and Dan and I are thinking about these portfolios that we're concerned about. The top of this chart, this is investment grade corporate debt and high yield corporate debt relative to data centers and AI related issuance. Look at the change in some October of 25. We're not talking a long time ago. Look at the amount of debt that's been issued. I mean, if you look at the high yield, It was 1% of the high yield market. It's 4% today. It's an incredible amount of issuance in this space. These tech companies were had a lot of cash on the balance sheet for many years. They've spent through the cash. They're issuing debt. They're issuing new stock. I don't know how this is going to work out, but this is something we've never seen before. And at some point, we typically overshoot and we correct back down. So we're just a little concerned about some of these things relative to AI. It's not that there's not opportunity there. It's all of these companies putting everything they've got into it. And again, there's going to be some big winners, and there certainly will be a couple losers that come out of that. We've not seen that the last 10 years. So anyway, we just want to give a little perspective. We're happy to answer more questions on that as we wrap this up. But Dan, I will turn it back over to you.
Yeah, and I'll just wrap up with two slides that I think are relevant to this group, and that we've got this ongoing IPO wave that is really ramping up right now related to artificial intelligence. And the positive of that is that there's going to be some of these shares that are in the hands of people that are philanthropically oriented, right? And so there's going to be some incredible wealth created through these IPOs that I think will make its way to the foundation and you all, if you're cultivating those relationships. And then also just an acknowledgement of kind of the sobering reality of the K-shaped economy, right? And I know all of you are boots on the ground and trying to fulfill your respective missions. And very often you're sort of right in the face of this and seeing sort of the lower end of that K. And what we're also seeing is that the conversation historically was focused a little bit more on income inequality, which is still relevant, but we're actually seeing the wealth inequality get more concentrated and have a bigger effect on spending and stability. And so we're now seeing the top 20% of net worth control 71% of the wealth. And so that concentration is creating challenges down in the lower half of the K. And then I also think that it's worth quickly touching on fixed income and yields, right? We've seen a lot of volatility around this recently. New Fed chair coming in, inflationary pressures, AI, like what is all this going to shape up to be? And in the last kind of 6 weeks, we've seen the long end of the Treasury yield curve move dramatically higher, and that is dampening economic activity. It's impacting mortgage rates. It's has a negative effect on growth. And it's really driven by investors calling into question, is the Fed going to be able to get inflation under control? And is our debt level sustainable? And I think those are really good questions. We've also seen time and time again that we're able to kick the can down the curb. We are seeing, because of the rise in interest rates, more of the federal budget going towards servicing our debt. And investors are effectively demanding a higher return on that. Our base case is that there's a very high bar for either raising short-term rates or cutting short-term rates. So we think the Fed stays on hold, barring a major shift in the data over the rest of the year. And they're also probably going to stay out of the market and not take any action right around the election, just to avoid any perceived conflicts there. So then, jumping into the portfolio, this is the kind of 30,000-foot view of the foundation investment portfolios as of the end of June. And you can see, alignment with the earlier conversation of the breakdown of the pools in terms of asset values and asset allocation on the bottom part. And then we get into performance, right? And as you probably have seen in your own portfolios and in the reports that you receive from the foundation, the first quarter of 2026 was really challenged, right? We had a lot of headwinds. We had the Iran war breakout in the month of late February, and so the month of March was very, very negative. And so the quarter ended slightly negative, but we've recouped all of that and then some in the second quarter. And so you can see that here with the long-term portfolio up 6% on the quarter, the social responsible and women's inclusion portfolio both up north of 10%. And you look at the last year and 3 years, and the returns have just really been phenomenal. So the last year, all in kind of the low to mid teens, and over the last 3 years, annualized in double digits, and even longer term, the numbers look really, really solid. Short duration fixed income, remember this is just fixed income, and with rates on the move higher year to date, we've seen a bit of a headwind there. The returns are still positive, right? And we're still anticipating the yield to maturity of these portfolios being in the kind of 5-ish range. And yet on a short-term basis, we've seen the negative impacts of higher rates. Capital preservation, just money market, and still in that kind of 3.5% to 4% yield range on a go-forward basis. This is just looking historically relative to benchmarks, so graphically showing that same performance detail. And then I'm going to turn it back to Brian and talk a little bit more about the long-term growth trajectory of the foundation portfolios.
Yeah, and one of the things we wanted to emphasize that, and especially with newer organizations to the community foundation, there can be a fair amount of volatility in the portfolios in those opening years. And that can be painful at times, and we recognize that struggle. But I do, and we wanted to emphasize, if you stick it out over the long run, it really works out quite well. This is just showing, the community foundation at 4.8 million, in 1995, it's 227 million today. And if you look at some of the big market shocks, the financial crisis, COVID, 2018, they're really kind of blips, right, on this longer term chart. And it's just a little bit of a reminder that, if you end up in these portfolios for 3, 5, 7, 10 years, multiple decades, you'll ultimately end up doing really, really well. There can be and will be certainly volatility in the short run. And again, it's just as you think about, like, certainly going into the endowment or the socially responsible pool or women's inclusion, there just needs to be a recognition that, that short-term volatility is there, but the benefits are obviously very, very clear when we look at over the long run.
And just kind of continuing to build on that theme, this is a comparison of looking at if you had, anticipated the crisis in 2008 and put money into the capital preservation portfolio versus the long-term portfolio, you certainly would have been better off the first few years. But in the long run, you can see the long-term portfolio not only recovered relatively quickly, but then continued to compound and build on the value creation there, where today the value differential is magnitudes of each other, right? And so that patience pays off is a theme that we want to continue to reiterate. This is another look at it, just looking at the long-term portfolio. We kind of hit on these numbers, but here you can see it from a cash flow perspective. Through all the distributions that have gone out the door, the foundation has continued to raise money and bring in a net $38 million, net of all the distributions that have gone to the community over the last several decades. And $100 million has been generated through the investment portfolio. And so sitting the long-term portfolio at 143 million today. And then I also think this is really interesting. It's kind of a busy chart, but if we just bifurcate this into the left side is looking at 1-year returns of stocks versus bonds. And so the dark blue lines being years where stocks outperform, the bright blue lines being years where bonds outperform. And you can see that it's, kind of a little bit better than a coin flip to be in equities on a year-by-year basis. But if we look at the right-hand side, which is 20-year horizons, there's 3 instances in history where bonds have outperformed stocks. And so again, patience pays off. We can, for organizations that can handle the volatility with endowed dollars, it's kind of a no-brainer to invest for the long run. And then this is also another way of looking at kind of the same story. I'm going to focus on the bottom half of this, which is the variability of returns over a 1 year period is pretty extreme, right? And so the blue is the S&P 500, just stocks, right? And so in any given year, the range is very dramatic. But when you look at over 5 years, 10 years, 20 years, that range narrows dramatically and skews progressively more positive, right? And so the 60/40 is a little bit better, comparison to what we're doing in the long-term portfolios. Not exactly our allocation, but gives you a sense of that narrowed range relative to equities overall, but also skews much higher than bonds on a longer-term basis. And then, Brian, you want to wrap us up with trends in philanthropy?
Yeah, and we just wanted to give a couple stats, and I was going to give a couple thoughts of some of the things that we're reading about right now and things that we're seeing in the marketplace. 2025 charitable giving was up about 5.7%. Interestingly enough, bequests were a big percentage of that in terms of the growth, about 20% there. And then actually giving to foundations declined about 16%, which was an interesting trend, something we haven't seen in a while. So we're going to have to kind of watch that. But the reality is overall giving looked really good in 25. 26 appears to be equally good at this point. I think we have to kind of see how the end of the year here plays out with some of the market volatility we're anticipating, but it sure has been a good first 8 or 9 months. We've been, I think, surprised how good that market has been. Dan, go one more.
Mm-hmm.
The other thing is just a little bit of break it down a little bit into the components, right? Where has giving been up? Where has it been struggling? Education foundation, public safety, environmental, animals, arts and culture, health, human service, international affairs, religion, and foundations. We made an adjustment for inflation as well. So you can get a little sense of kind of where things have been heading. And then I think this is the other thing that, this is a lot, but I want to paraphrase a couple things. There are a couple things that we're seeing in this space that are important. One is there's a lot of conversation going on about, in the old days, big philanthropic dollars created programs, medical schools, buildings, they built things. The trend in the last decade or so has not been to do that. And we actually think there's a potential, sort of given where we are with the AI boom and whatnot, that we return back to this sort of building phase. And so there's been a number of conversations around this. There was an article written by Sarah Cohn from the Stanford Review, really talking about why this is likely to kind of come back around in the next couple of decades. The other thing is this sort of third wave of philanthropy. And I'm not sure if all of you are starting to hear about this, but there's a lot of conversation about the third wave of philanthropy is about this AI boom. And there's two components. One is the amount of wealth that's being created by this AI boom, of which, being in the Bay Area, the hope is there's significant dollars headed to all the organizations. The other part of it is, will giving change? Will AI and the ability for people to search and do their own thing create a different type of giving? I think that's TBD, but it's certainly something that we're already seeing a little bit. And so those two things we think are going to be interesting trends to watch. And then, the final is this idea of, job quality and, how do we, Dan mentioned the K-shaped economy. The top end is doing very well. The lower end is really, really struggling. And how do we take the low end and get them invested in capital and things that will appreciate over time? And I mentioned that earlier with one of our managers, Apis and Heritage, where they're giving capital for employees to buy out founders through ESOP programs. And so it's something that we think actually is a trend that we're seeing, where maybe the way to actually bring up the lower portion is to start figuring out a way to make them a part of the actual capital and the infrastructure of these businesses. And so this is a conversation we haven't seen a lot. It was always these founders kind of held onto these things and they'd sell it to another wealthy person and move on. But we're starting to see more and more conversation around how do we give the business to the actual people who work within that business? And it's not just a salary thing. They now have some equity exposure. So those are the kind of things that we're reading about right now. Those are the kinds of things that we're seeing more and more. Um, you know, I'll reemphasize, we're in for a very interesting second half of the year. I think it could be a record-setting philanthropic year, especially in the Bay Area, given the industries that we're around. Um, but again, I think how we deploy this capital, are we ready for all this capital? All those things are, those are good things to be talking about, but I think they're realistic in terms of what could happen going forward. So with that, Hillary, I don't know if I'm turning it back over to you, but we'll answer any questions that you guys have, and happy to go through that.
So helpful. Really appreciate you.
Thanks for the time, everybody. And as always, we're always available for conversations. And so let us know what you all need. Thanks, everybody.
Great.
Yep.
Thank you.
Thanks, everyone.
So we're going to shift over, and my apologies. We normally share the agenda beforehand, but you guys are we're flying by the seat of our pants today. So you are all in very good company. We have 76 agency fund holders, I believe. Yeah, 76 agency fund holders. We have a lot of new agency fund holders this year alone. We so appreciate working with all of you, and we want you to know that we're here to be a resource. So beyond just getting this information today, please don't hesitate to call on us if we can ever be of help. And I know, especially as year end, lots of questions come that you may not be able to answer, but reach out to us. If we can't answer them for you, we will certainly find someone that can help. And we just want to shift a bit into our trends here locally. Dan and Brian talked about sort of the national trends, what was happening. You can see on our Community Foundation gift received, we do have a big blip in 2022. That was a result of the Watsonville Community Hospital Fund, which came to the foundation and then went to the hospital. But still, we are on track for giving here locally. That's been just strong. The floods in 2023, certainly another moment of our community rallying and giving, but just on an ongoing basis, the gifts that are coming in are pretty tremendous. This year has not been an exception to that rule. We've, like I said, been surprised at what we're seeing even in the summertime, which tends to be quiet months here at the foundation. It has not been this year. Additionally, we just remind you all that we do an extensive amount of planned giving here at the foundation. We've had a number of our new memorandum of charitable intent come in where folks are really thinking about leaving funds to the foundation to distribute to all of you. That is often what happens with those memorandum of charitable intent or our mochis. And we work with your donors. And so if you need help on plan and giving discussions, Kia will get into that in a moment. And then the other piece that I cannot stress enough is do not forget the QCD gifts. The qualified charitable distribution gifts from folks' IRAs are really coming in ways that we have not seen before. We can help your donors if they want to distribute those to multiple organizations, but please don't forget to mention that as you are talking to donors, because it's a real opportunity to get not just a one-time gift, but once folks do that on a one-time basis, they often think, oh, I need to do that again next year. So we have a very generous community on that front. And then just from the Community Foundation perspective, there's a small portion of what we do is our spring grants, but a huge portion of what funding comes to all of you. And when you see those magical emails from Alexa that funds are headed your way, a lot of that is from our donor advised fund holders. Our donor advised fund holders are very, very active, much higher than the national percentage. That's why we stress keeping your impact profiles up to date, because that is really their catalog for local giving. They can understand your mission, your projects, your annual budget, and what impact their dollars are going to make. So really important for this time of year to think about, is my impact profile up to date? Am I emphasizing projects that might matter here locally? And we are finding that as things become more and more stressful on the national level, that our donors are really focused on local giving. So please don't forget to keep those updated. And again, reach out if you have any questions on that. The other thing I will say about our donor advised fund holders is please do not forget to thank them. Although it may look like a grant coming from the Community Foundation, it is so meaningful when they get letters of appreciation from all of you. If you have questions about how to do that or with how to address those letters, let us know, reach out. We're happy to help, but we send them all along. It is really important to thank the donors. And at this time of year, I know we're all really busy, but the thank yous really do matter. And then don't forget about Santa Cruz Gives, that's coming up. And that has been, again, another way where not only donors get involved here with the foundation, but get involved locally and learn more about your organization. So that comes up this fall. And then many of you on this call either have an agency flex fund with us or an agency endowment. They are two very different vehicles. The flex fund is really for operating reserves. You can access those funds anytime. If you need a distribution, please don't hesitate to reach out to me and the team. We're happy to help with that. Those are really easy ways to get started. And oftentimes I talk to a lot of different boards about creating an endowment, but a flex fund gives you, you can almost practice an endowment. If you put the money away and you don't need it for 3 to 4 years, you might want to think about shifting some of that to an endowment. Once you create an endowment, that is a permanent invested fund. So unlike a flex fund where you can have the money back and or have distributions at any time, an endowment is permanently invested for your future with the foundation. We give annual distributions. They come out in late February every year. I'm happy to talk to you about those as well. And Kia will go into more of the discussion around endowments and how that could really help with your planned giving program, which is so important. And then we'll a little bit about the investment. I know that we really have had a deep dive into that, but we want to let you know one thing that's really important that we don't get an opportunity to talk to you about enough is you are invested in these different funds, whether it's the women's inclusion, the long-term portfolio, socially responsible, or some of the shorter term. You may change those once a year. So don't we don't want you to game the market. However, we don't want you to forget that oftentimes, sometimes we create these flex funds or we create single agency funds for a specific project. And those tend to stay in the capital preservation or short duration. But after the project's over, if there's still funds left, you can switch that into one of our longer term portfolios when the concern about we don't need this for the immediate. And now we can even offer to any of you that are interested, if you want to diversify your portfolio, and we are having organizations start to do this, where you can see it, it's in our custom blend. Some organizations are saying, I'd like to be in women's inclusion and I'd also like to be in the socially responsible pool. So we're happy to have those discussions. So that's, again, you can change that on an annual basis, but it's something to think about and to talk to your boards and your finance committees about, because we're more than happy to work with you. And in your post-event email, when we do send you the slides, we'll also send you a copy of that form. So it's right there in front of you. It's a really simple one page. Just let us know how you'd like to be invested. And also feel free to reach out if you have questions about that. And in thinking about today, one of the reasons that I really want to stress that being able to diversify, we had at the beginning of the year, that anticipation of the Fed chair really dropping interest rates did not happen. And we had organizations saying, gosh, I'm going to be staying with capital preservation because I'm worried about what's going to happen this year. This is just a quick snapshot, and what we saw is that organizations, these are your fund statements, you all receive these on a quarterly basis. Please don't hesitate to reach out if you have questions about those. It not only tells you what your agency is currently invested in, but what distributions have been made, if any, and earnings and losses on those funds. But if you're looking at these two, and again, we'll send you this so you can see it side by side, but the difference between a capital preservation and a long-term pool investment, even in a very short term, just a 1 quarter window, is pretty tremendous. It's over $1,000 difference for a $25,000 fund. So these investment choices really have impact. So again, if you're here with us for the long haul, you may want to think about how you diversify your investment portfolios with us. And with that, I'm going to switch it over to Kia Gordon to talk a little bit more about endowments and how endowments encourage our planned giving, and a bit more about the work that we're doing here at the foundation.
Thank you so much, Hillary. I wanted to make sure that we had gone over how endowments can encourage planned gifts. As you heard Brian mention, we've seen a dramatic uptick in bequests. We've seen in the donor mindset the question of how do I actually support something that's going to last and build that true community infrastructure. So an endowment is a way I think of as an organization making a commitment to its own future. Many organizations spend their days raising money for what needs to happen this year, and that's absolutely important, of course. An endowment allows us to think beyond the next annual campaign or the next grant cycle and begin building resources for the organization that we hope will be there for generations, and to instill that faith in our donor community. Endowments are not unusual or reserved for very large institutions or organizations. We already partner with more than 60 nonprofits that have established endowments with us. So this is something that organizations of different sizes can incorporate into their long-term fundraising strategy. But I think there's another reason to consider how endowments are truly important for your organization's sustainability. They create a natural pathway into planned giving. Once you have an endowment, you have a very tangible answer when a donor asks, how can I make sure this organization is still strong after I'm gone? So if you think about someone who's been giving to your organization every year for, let's say, 15 or maybe 20 years, they may never write you a six-figure check. But through their estate, that same person may be capable of making the largest gift they've ever made. So instead of saying, will you put us in your will, you ask something like, you've supported this work for a long time. Would you like to make sure that your support continues for future generations? And if they say that yes, there are a number of ways they can accomplish that. So we wanted to go over some of these planned giving tools that we have here at the Community Foundation. Let's start with the memorandum of charitable intent that was mentioned before. You saw that slide with a real uptick of these, what we call mochis. So a memorandum of charitable intent goes hand in hand with a donor's estate plan. And this is, think of the donor who says, I know which organizations I want to support after I'm gone. I want to make sure those wishes are clearly documented. The mochi gives us a roadmap for the Community Foundation to carry out those charitable intentions. So the gift comes to us from their estate once they've passed away, and then we make the distributions per the donor's designations in the memorandum of charitable intent. Now with QCDs, think about your older donors who have retirement assets and they're looking for tax efficient ways to continue supporting the organizations they care about. When they hit 70 and a half, they are required to take a minimum distribution from their individual retirement accounts. And they oftentimes will come to us and say, can you help make these distributions for us? So if you don't already have something on your website that says you can accept qualified charitable distributions, it's something I would highly encourage you to add. And if you have any other questions about that, let us know. We're happy to unpack some of the alphabet soup of planned giving. And that gets us to the charitable gift annuities. Charitable gift annuities and charitable remainder trusts. I don't expect anyone in the room or our virtual room here to know how to administer a charitable remainder trust. Or really even to know all the ins and outs of why someone would go with a charitable gift annuity versus a charitable remainder trust. That's not the goal. What we want to know, is that there are these tools available for donors in very different circumstances, and that you can call us when one of those opportunities comes up. So these are kinds of gifts that provide a lifetime stream of income or a term of years to the donor or one of their designated loved ones. So the donor gives us resources. We put them in one of these vehicles called a charitable gift annuity or a charitable remainder trust. And that's going to pay them income for the remainder of their lifetime. They're going to get a deduction in the year that they set it up. And then the remainder comes to you. It can come to you nonprofits. And those of you who have funds with us, those are the kinds of organizations that we're going to be highlighting when they say, well, what can I do with the charitable portion when this gift comes to its end. So your job isn't really to recommend which vehicle they should use. It's rather to recognize that there's a charitable opportunity when someone tells you that they're thinking about including you in their estate plans, if they're thinking about, the longevity of your organization, and bring us into the conversation. We're happy to help in that way. And so that brings us to our next slide here, the benefits of agency funds at the Community Foundation. And I really would love for you all to think of the Community Foundation as an extension of your development capacity. Many nonprofits aren't going to have a plan giving officer on staff, but you don't have to have someone who knows how to accept a piece of real estate, evaluate a complex asset, establish a gift annuity, or work through a charitable trust. You don't need to build all that infrastructure yourself. If you have an agency fund with us, we are so happy to help you move beyond simply saying, please make a gift or an endowment. We can help you think about how a donor might actually make that gift, particularly when the opportunity involves something more complicated than cash. And in fact, I want to emphasize that, with all the discussion about investments and what's happening down the pike and concentration and diversification, we're seeing quite an uptick in donors who are looking to diversify their investments by using these charitable giving tools, such as charitable gift annuities and charitable remainder trusts. So we're seeing that people who are in these concentrated positions are not necessarily just saying goodbye to the cash. They're actually looking at these kinds of giving vehicles that will pay them some of that income back, but then the actual remainder will go to the nonprofits at the end of their lifetime. So I'm happy to talk with you about these kinds of giving vehicles. We can also help prepare your board and your development committee for these conversations. Hillary's done such a wonderful job of really getting boards on top of why endowments make sense. And it goes the same for plan giving. It doesn't have to begin with a sophisticated program. And we're happy to have those kinds of conversations. So I'll just wrap up by saying that when you go back to your organizations, I'd like you to think about maybe 5 or 10 people in terms of the plan giving conversation. These don't have to be your wealthiest donors. I mean, certainly we've talked about trying to identify those who have these opportunities with IPOs and AI boom, et cetera. But with the plan giving conversation, we're talking about your most loyal donors, who's been with you for years, who really understands why your work matters, and who would be deeply happy to know that something they created could continue supporting that work after they're gone. So that's really the connection between the endowment and plan giving. The endowment creates the opportunity for permanence, and plan giving gives donors a way to create it. So with that, happy to turn it back over to Hillary, and we're going to answer any questions that may have come up.
Thanks, Kia. Appreciate that. And don't forget that if you have a donor that reaches out to you and says, I have a share at Pasatiempo Golf Course, I have some IP, I have a copyright on a song. If you get a question about a gift, do not hesitate to reach out. We will do it all. And again, if we can't figure it out, we'll find somebody that can. We just don't want you to miss that opportunity. And to Kia's point, really, if you own a home in Santa Cruz County, oftentimes it's those donors that may never give to you in their lifetime, or may give you very small gifts. But if they have a piece of property and they own that can be an incredibly powerful gift at the end of their lives. So we're here to be a resource. We're happy to come talk to your board or your committees. We do have a couple of events coming up that we wanted to share with you. Although our board mixer is sold out, we've never had a sold out event at the foundation that I know of, but this one is sold out. Please sign up again next year, early and often. And then we also, upcoming event that should be really helpful, on the 27th of August, we have our nonprofit advocacy roles, rules, and responsibilities with a great panel. Jan Brown, communications expert, Laura Seaman from the League of California Community Foundations, and Ray Cancino, that so many of you know so well, one of our dear nonprofit leaders here with Community Bridges. And then also, and just a hot off the press, October 14th, Financial Health and Resilience for Nonprofits with Michael Bryant and our own very own CFO, Sabina Dukes. Michael is a CPA that many of you may know. He does nonprofit audits. He's an excellent resource, and he'll be here talking with Sabina about financial health. And at that time of year, it's really important to get focused on that. And with that, if there are any questions, we're happy to take them. But again, know that we're always here to be a resource, and don't hesitate to reach out to our team.